Hello and welcome to ETF Pulse, ETF.com's podcast. I'm your host, Kristin Myers, editor-in-chief of ETF.com. Here as always with my co-host, president of the ETF store, Nate Geraci. Let's take a quick look at the Pulse rundown. So first up, the US and China have cobbled together a temporary pause on tariffs. And we're going to let Nate start the show with a bit of a victory lap to kick it off. And global equities continue to outperform US equities, but can that streak continue, particularly since we do have that tariff pause? We'll be talking about that. And there is a new cage match that has now been set up between gold and Ethereum and Bitcoin. And that's all in the new launch of several Battleshares ETFs. So we'll be chatting exactly what you can expect in some of those leveraged asset plays. Plus, we'll be taking a look at some of the inflows and the performance into IBIT as Bitcoin has been absolutely soaring. And last up, we'll be taking a look at gold. It could hit $5,000 an ounce, at least according to the folks over at Van Eck, as market volatility has sent investors running to that safe haven asset. So, hello, Nate. How are you?
I'm doing fantastic. I'm really excited for this victory lap. I hope you have music to where I'm picturing me entering like a Roman Colosseum, and there's trumpets, there's rose petals coming down for me to take my victory lap.
I'll see what we can do in the edit. And so if the final version of this has, the final countdown playing in the background or like Eye of the Tiger or something, then we'll know that we were able to do it. So here we go. We have a temporary, just as a quick kind of like context setting and reminder for everyone, if you haven't been paying attention this week at all, on Monday, we saw that the United States and China essentially decided to pause the trade war between them and lower the reciprocal tariffs. It was at 125%. It is now sitting at 10%. Total tariffs on Chinese imports are now at 30%, still 10% for US exports to China. And the markets went crazy. And it just goes to show that you should not have panic sold when tariffs happened, which again goes back to your theory, or not even theory, but essentially your very clear sort of, I don't know if I want to say a call to arms, but your very clear statement that you made where you said tariffs are not investable. Do not invest around it. The stage is yours. Victory lap. Nate Stradamus struck again with another correction.
First, I would like for you and the ETF.com team to go back and splice all of my takes on this over the past month and a half and put them in a really nice package, and we can put that music I was talking about behind them.
I'm gonna have I'll get our social team on it right away.
All right. So look, this thing played out exactly as I expected. And people who know me, you know me very well. You know I'm not really into market predictions. I'm the one that is always out on X saying nobody knows anything. And ironically, Kristin, that's actually what guided my thought process over the past month and a half, because I saw all of these so-called investment experts, right? The smart money, they all of a sudden became tariff experts. And that was an initial red flag to me. Just anytime you see everybody pivoting, all of a sudden they're, an expert in this or the other. But when I see people trying to make investment decisions based on President Trump's negotiation tactics, that seems absolutely insane to me. To wake up and say, I'm selling everything because President Trump slapped 145% tariffs on China or whatever. Did you really think that those were going to stick? And my whole point this entire time has been nobody could predict how this tariff situation would play out, right? From one day to the next. That's what I was saying from the very beginning. And so it's not that we shouldn't, stay abreast of the news, pay attention to what's going on. But to what you were saying, I just believed it was uninvestable. The other thing that I think I have to mention here, and I think you'll like this because you and I have talked offline, I think you like talking politics. But, I always like to stay away from politics in this forum. You and I can talk politics at the bar or whatever, and we enjoy that. But I like to stay away from politics in the investment setting. But I've got to say, I really believe a number of investors let their political views or their political bias get the best of them in this situation, right? Because there are these people who can't stand President Trump, and they got all caught up in how he was handling these tariffs. And they didn't take a step back and go, you know what? This is how he always handles these things. This is exactly what he's always done. I mean, he's been doing it. Did you ever watch The Apprentice back in the day? Do you remember that show?
Love watching The Apprentice.
Well, but if you watch that, then I think for a lot of people, certainly they were familiar with Trump before he did that show. But if you watch that show, it just gave you such a window into how he operates. And it's not predictable, right? From one show to the next, or within a show, like you never knew what was going to happen. That's why people watched it. It was reality TV at its finest because you didn't know what would happen.
People that he had no plans on firing. They might just say something wrong or look.
Right.
And he was like, I think one guy was like, I'm just like white trash, whatever. And he's like, oh, hold on. I was going to fire so-and-so, but I don't like my people referring to themselves as white trash. You're fired. And everyone was like,
but that's how he operates, right? And I'm not saying that's good or bad. I'm not here to debate that. I'm not here to debate
no,
whether
it's just a fact. It's just a fact.
Right. I'm talking about it from an investment perspective.
You can't invest around a political policy that may or may not still be here tomorrow. I mean, I think sometimes what happens, inside the Beltway is definitely important for investors to know about. And it's important for Wall Street to know about. Issues around things like taxes, for example, are important. And you're going to want to know about it because it's going to impact, the economy. And therefore, it's going to impact markets. And so you can't just completely ignore it. But I agree with you. I felt like the whole tariff situation was just too chaotic for you to create an investment thesis around. Like it was not ever something that you could permanently say, okay, this is now going to change, the structure or how the US economy is going to perform going forward. And I therefore now need to make some kind of pivot. And most political decisions, frankly, aren't. Some are, and others aren't, right? And you have to kind of be cognizant of that. And it doesn't matter whether you like who's in office or not, whether you're a Democrat or a Republican or it doesn't matter, right? It's just, these are the facts and they should be able to they shouldn't be impacting your investment decisions because you shouldn't be emotional when you make some of these sort of like investment calls. But I think, again, when it comes to politics is a very emotional thing. And so is money, right? And so when you have those two kind of forces colliding, it gets people very riled up and absolutely freaking out.
I couldn't have said it better myself. I love how you frame that you're right. Money is very emotional, obviously, and politics is very emotional. And so if you combine those two, that's a really bad combination. The other factor that I'll add into that is just the media. The media loves stories that are wrapped in politics. And if you're an investor, you have to really have a good filter. Where are you getting your news sources? How are you digesting that? Because that can even get your emotions going further. And so I just think that's another factor as well. And, if you're out on social media, that's politicized. It's tough out there. And you just have to check your emotions at the door. And I'm going to say what I always say, we can move on. Don't mix politics with portfolios.
Yeah, if you don't want to talk about it at the dinner table at Thanksgiving, then don't think about it in your portfolio. It should be the Thanksgiving test.
Love it.
Well, quickly, I do want to take a look because we have seen retail ETFs obviously just completely popping on the news. Of course, when it comes to things like consumer discretionary, which obviously was very heavily impacted. I mean, it is in the green right now. I'm looking at XLY, so that's a consumer discretionary select sector SPDR fund. I was just looking at the 1 month performance on this, up 12%. So consumer discretionary is still continuing to beat the broader market. Year to date, it is down more than the broader market is, of course, as we've seen US equities really rallying. And then China ETFs, I mean, we had absolutely seen, I'm pulling up fund flows right now on the screener. I mean, ouch. I mean, MCH right now is just one of the largest China ETFs. That's the Matthew China's active ETF. I mean, we've just seen nothing but outflows from these funds, honestly. I mean, year to date, it has lost almost $17 million just in that one fund alone. But again, performance, I mean, we have seen, we're going to talk about this next, global is very much outperforming and international is outperforming US. And that is also true with MCH and some of the China ETFs. I mean, 1 month up almost 10% right now, which is slightly beating what we have been seeing in the US market. So I do want to talk about that. So we kind of, this was one of almost like the first topics that we ever talked about, you and I, right? And you said, everyone says that this is the year for international. And if international really doesn't, I don't have the exact quote of what you said, but you essentially said, if this is not the year that international performs the way that everyone has been saying it's going to every single year, then this might be the year that people kind of move away from international. But it looks like this is the year that international is doing exactly what people said it was going to do. I pulled up a couple of funds. We had VX US, so that's the Vanguard Total International X United States Fund. It is up 11%. That's year to date. SPY, right? So the S&P 500 ETF from State Street, it is down 3.5%. So we do have global equities handily, very handily beating what we see in the US. Curious to know your thoughts, just like bringing it back, because now that we have this pause on tariffs and some of the geopolitics, I mean, it's going to continue some of that volatility. Do you see that sort of streak continuing? Do you see what we are seeing in the international kind of equity space kind of fueling that continued interest in international? Because you said this is almost like the make or break year for international.
Yeah, I think the interesting dynamic to watch here is that a lot of financial advisors in particular are underweight international stocks. So I see a lot of portfolios from different advisors. And just in looking through them, I can tell you a number of them have significantly reduced international exposure over the past several years. And I completely get why that's the case, right? It's been brutal being allocated to international for the past 10 or 15 years. But I do think if international stocks keep running into what you were just talking there with a performance, I mean, if you just look high level, you look at broad US stocks, you look at broad developed international stocks, and then you look at emerging markets, international is outperforming, by something 10 to 15% this year. And so I think if we continue to see something like that, the way I would describe this is that presents a real issue to advisors who are underweight. And so what they might do is they might try to start chasing that performance. They're going to hear from clients, why aren't we allocated international? I thought we were supposed to have a diversified portfolio, right? Those sorts of things. And so you'll get the advisor community start buying international ETFs. And I think that could obviously be a tailwind to the space overall. So I'm not, me, even though you call me Nostradamus, I'm not here to make market predictions or price predictions. So I'm not going to predict what international stocks may do. You can talk about that. But I do think in terms of investor interest, I absolutely think if even if the performance just remains what we've seen, I think we'll continue to get a lot of interest in the space. Real quick, I will say on the China ETFs that you were talking about, the issue with those is that you have to have a stomach of steel if you're going to invest in China ETFs. Go look at the volatility profile of those. It's tough. And so if you look at China ETFs in particular, I think that I'm not so sure the interest will be there. Obviously, those keep running, then maybe. I just think that's tougher to allocate to directly because of the volatility.
Yeah, and I mean, there's a lot of a good number of emerging market ETFs that actually strip out China, particularly for that reason. Obviously, China being one of the largest emerging market economies that we do have, but there's a lot of people that I think struggle to invest around China just because of what happens in China. As much as it's actually kind of interesting because as much as we were talking about sort of like the chaos theory that can kind of exist with Trump and his policies, the same thing can also very much sometimes be said for Beijing. You never know when you're going to have a devaluation of the yen. You never know when you're going to have a massive stimulus or influx. You never know when they open up markets, close markets back down again. You never know when they decide to go after some of their largest publicly traded companies. I could
have said it better myself. I mean, think about just a few weeks ago, the US, and I get this was part of the tariff negotiations, but talking about delisting Chinese stocks or Chinese companies from US exchanges. Like, you don't know what's going to happen. So I would agree with you. I think any emerging market, any market has its risks, but certainly some of the additional risks we've seen out of China over the past several years should get investors' attention. And that's why those stocks have been as volatile as they have been.
Yeah, I can't think of another emerging market country that kind of gives you that lack of almost stability in the same sort of way, right? Obviously, volatility is the name of the game when it comes to emerging markets for a variety of reasons. China definitely has more, I think, than the rest of their counterparts. You certainly don't see this kind of stuff happening with India, for example.
By the way, can I give one of my favorite stats? I know I've given this on the podcast before, but I always come with some stats for you.
Hit me.
So I love the stat. It's not quite as compelling as it was when we talked about it earlier in the year. But if you go back to December 2007, complete cherry pick date, the iShares Emerging Markets ETF, so ticker EEM, you know what the total return of that is over the past, 18 years?
You're about to tell me.
30%. So 30% total over 18 years. And actually, I said it used to be kind of like one of my favorite stats. Favorite's probably not the right word. Mind-boggling is better. It was flat. Like if you go back into last year and looked over that time period, had you invested in emerging markets over that 17-year time frame, dead money.
But you
Think about that.
the Widowmaker. I'm still waiting for you to give a particular fund the same kind of diminutive
Like TLT.
you gave TLT.
Well,
30,
TLT has incinerated boatloads of cash, whereas at least with this one, it's just dead money. I mean, you would have lost on obviously an inflation adjusted basis, but
that's
yeah,
very 30%. And that's almost surprising because I think I hear so many people always saying emerging, and they pick particular countries, right? And I think right now it's like India's moment, but there's people that come out and they're incredibly passionate about what they see as the base case as like India or particular emerging markets as being like the next frontier. And they're like, and if you're not in it, you're going to miss out on that, like thousands of percents of return is almost like what they always say. But I think that's a very good gut check. If since 2000, you said 2007, right? Not even
2007. Yeah.
I mean, that's almost 20 years ago. That's 18 years ago. Only
But I'm going to tie
that's sad.
I'll tie this back into what we were talking about or what I was talking about with advisor portfolios and international stocks, because here's the way you have to think about this. A lot of advisors, including myself, have been schooled in this, globally diversified portfolio allocation, right? You have US stocks, international stocks, emerging market stocks, you have US bonds, international bonds, maybe you sprinkle in some gold or alternative assets. And because of the performance we're talking about here with something like EEM, and if you go look at the iShares Developed Markets ETF, so EFA, going back to that same date, it's up like 70%, which is still peanuts compared to what the S&P 500 has returned. But my point is that it has been really hard if you're sort of a traditionally schooled advisor and you have this globally diversified portfolio, you have underperformed, the market, the S&P 500 for a long period of time. And so what's happened is, that's my point, advisors have continued over the past several years to ratchet down that international allocation. And so now we're at a point where I think a lot of advisors are significantly underweight. And so if we have this performance churn and it's real, I think you could see boatloads of money coming into international ETFs. It's going to be interesting to watch.
That's actually, I mean, a topic for a different podcast, but almost like the portfolio allocation, because I think the standard models are pretty much all dead now, right? Like, I mean, we've been talking about the 60-40 split for, I would say, the last couple of years. Is it still needed? I think I keep seeing a lot of headlines like the 60-40 portfolio is dead. I mean, I think, again, those traditional models of like around like allocation and what you kind of see, I think for most, at least of retail investors. So for any retail investors that are watching this or listening to this, that you see that come up, right? When you have your 401k, it'll kind of tell you like, oh, you should have like this much in international, this much in fixed income, this much in equities, right? According to whether you want growth, aggressive growth, moderate growth, low risk, whatever types of portfolios. I don't think that they seem to be very divorced from the reality, some of these like models that we have that exist out there. But that's a topic for another day. Let's talk about, I wish I had one of those bells, those like ding, ding bells, because let's talk now about Battleshares ETFs. I'm going to actually pull up the names right now. Okay. So we have, let's see, it's 4 ETFs that were filed, right? And it is essentially pitting Bitcoin against gold against Ethereum. So here's what we have. We have the 4 proposed funds are this: the Battleshares Bitcoin versus Ether ETF, the Battleshares Ether versus Bitcoin ETF. Now, remember, the reason one name is in the other is determining which one's leveraged and which one's shorted. Then we have the Battleshares Bitcoin versus Gold ETF and the Battleshares Gold versus Bitcoin ETF. None gold versus Ether. But anyway, we've set up Bitcoin against Ether, Bitcoin against gold. So, for example, the Bitcoin versus Ether ETF has a long position in Bitcoin, about 150% to 220%, and then it simultaneously shorts Ether at the same time. Whereas the Ether versus Bitcoin is the absolute thing in reverse. So you're going to go long on Ether, short on Bitcoin. Are you excited about this? Look at your face.
Well, one thing I'll mention too, and we should look at the prospectus. I believe they can use leverage to the downside as well, right? So there's leverage to the upside, whatever you said, 150 to 220%. And I believe that's the same on the downside as well in the short position, right? Yes. And the other thing that I'll note, interestingly,
it actually sorts the same amount. So it's you're leveraged up one amount and then you're leveraged to the downside the same amount in terms of that.
But Battleshares actually has a live product on the market, and it's one where it pits Tesla against Ford.
Yes.
And then if you look, they have a number of other filings. I think you're right. I think we did talk about that.
Talked about this.
But they have filings, like there's one that's Coinbase versus Wells Fargo. And so you can see what they're trying to do here, right? They're saying
Well,
here's
they're living up to their name. I'll tell you that for Battleshares. I mean,
they are.
that's the
But you
whole.
can see what they're doing. They're trying to say here's sort of the future and here's the past is kind of the way I look at these
Yeah.
in general. With the four that we're talking about here, I just wonder how big the audience will be for these, because my experience has been that if you believe in gold, I think you're more likely to believe in Bitcoin as well, because these are both thought of as stores of value, right? And both of these, somebody has to buy them from you at a higher price. There's no cash flows associated with these. So pitting these two against each other, I just wonder how many people would actually be interested in doing that.
You're talking
And
the Bitcoin versus.
I'm talking specifically the Bitcoin versus gold. I'll talk about the Bitcoin versus Ether in a moment. But
to be fair, right, this hasn't happened over the last maybe month, 6 weeks. But I'll actually do the comparison tool right now. But there actually has been a divergence in the performance between Bitcoin, if I pull up like IBIT versus GLD. They haven't actually always moved in tandem. Again, and we've talked about this a lot because there is this almost existential question around Bitcoin specifically. Gold has long been established, right? But there is this sort of question on how people view Bitcoin or view IBIT. If you want to look at the fund, how it performs in their portfolio if they are looking at it as a store of value. We have seen more recently that it absolutely has been thought of as a store of value, but it hasn't always performed that way over the last couple of, I mean, we could even just say 1 year. There's a very clear.
Well, and that's the bet here, right? It's that, like if you do the Bitcoin versus gold one, you're saying that gold is the old store of value and Bitcoin will be the new one. And so you're effectively betting on the, the digital piece, right? With Bitcoin being digital gold. But Kristin, I don't have any, like we talk about these types of products all the time. I don't have any issue with these existing. And again, I just go back to, I don't know if anyone really needs these. And keep in mind, it's hard enough to get one investment bet or decision right. In this case, you're kind of making two bets. Now it's a relative bet, right? If you're just saying, okay, I think Bitcoin's going to outperform gold, or, Ether's going to outperform Bitcoin or whatever. But, if you believe in Bitcoin, why not just invest in Bitcoin? Or if you believe in gold, just invest in gold. I think trying to, pit them against each other, just it's some unnecessary complexity. Now, what I was going to say with Bitcoin versus Ether, like I know you see this if you're out on X or Twitter. I mean, there are diehard camps on both sides of these. I mean, these Bitcoin maxis and Ether maxis, they'll bludgeon each other. They go back and forth on, who's the future. But I feel like for most investors, most allocators, if you're generally bullish on crypto overall, then you might want to own both of these digital assets, right? Even if they're very different, like Bitcoin is a store value or supposed store value, and Ether is a technology like we've talked about. I think if you want exposure to crypto, are you picking one over the other, or are you going to spread your bets a little bit?
I'm actually surprised they didn't do an Ethereum versus gold one.
Well, those just seem so different to me. I mean, you could then pick anything, just because again, I think Ether is more of a technology play. So that'd be like do the Qs versus gold or something like that.
I mean, yeah, but I mean, I just think that this is, to your point about who wants this or who needs this. I think that the market is running towards volatility. And this was something that I was actually thinking about as we've talked about this before, just like the leveraged inverse fund space, how rapidly it's been exploding. And there's a lot more filings that are kind of coming out that are on the volatility play. I think that more and more, which is for retail, right? This is retail investors that are doing this. I think that we do have a lot. I think it's just trying to capture the trader market inside of ETFs and coming up with new, interesting ways to, again, capture in some of that volatility. I do think, however, a lot of retail investors, one, don't need this, as you mentioned. If you believe in Bitcoin, you could just either buy Bitcoin or buy a fund directly. You could hold both IBIT and both GLD in your portfolio. You do not need to leverage them you don't have to pit one against the other. You could just buy and hold them both. You can actually buy and hold all three of these, actually. You could just get Ethereum, get Bitcoin, get gold, and hold all three of them in their portfolio. I don't know if you need an 150% leverage to the upside for Bitcoin against an 150% leverage to the downside against gold, because again, you're going to have to move in and out of this product regularly. You're
And
never
again, you're expressing a view on two assets, for each ETF. And so you got to be right twice, or at least right on a relative basis of one versus another.
yeah.
So I'm not saying that's not possible. There aren't people who,
I just
don't
don't
want to
think
do
most
that.
I just don't think most retail investors, one, should want to have to do that kind of work. I definitely wouldn't. And two, I don't think a lot of retail investors can do that work. I think a lot of retail investors are going to be wrong. A lot of it.
Maybe, but I mean, that hasn't stopped retail investors from buying a plethora of ETFs over the years, right? And I'll say this, the Battleshares branding, I love that. Like, I think they've hit a home run. I just think that I love sort of the branding concept around Battleshares.
I absolutely love it. I mean, I do. And I'm almost curious to know what they're going to come out with next and what they're going to pit next. I mean, I love the fact that as a issuer, they really are seeming to be able to press right on the trends. And I liked what you said. It's about the future versus the past between.
Yeah. And again, I like that concept, the idea there. It's just, we're saying the same thing. I just don't know how many investors, want or need these. I mean, I think if you look at the Tesla versus Ford ETF that I mentioned, I don't have the ticker in front of me. I believe that only has like $1 million or $2 million in it, total assets.
I don't think anyone could think that any of these ETFs will ever pull in the kind of AUM, like massive amounts of AUM. Like I just, to your point.
Your hope is to catch lightning in a bottle with one of these, right? Where maybe there is some huge, massive divergence between the two assets and you get a bunch of people wanting a short-term play. And so assets pile in. Certainly that could happen. And, maybe that's what they're hoping for here. But we'll see. Again, I have zero issue with these existing. I love the innovation in the ETF space. Love the Battleshares brand, but I think it's going to be a tough uphill climb for these. I could be wrong.
I think it's called Elon, by the way. The Elon
I should have known. I can't believe I didn't know that ticker.
Versus Ford ETF. I just pulled it up. I just pulled it up. We've got net flows year to date, 2.8 million.
When did it launch? Do you have the inception date there?
Let's see. I could pull that up. Let's see my overview. I'm scrolling down. Okay, so the inception date was February 12th of this year.
Okay. So 3 months, basically, a few $1 million.
Yeah. And looking at the performance, I mean, it's 35% over the past month.
And that's what these are going to have to do, right?
There
that's
you
how
go. No denying it. You're up 35%. You are massively beating. I don't think I've seen something there's others that have performed that well, but I just can't think of them at the top of my head. We're going to be talking cryptocurrency. Well, we're going to keep an eye on it. Okay, so let's take a look really quick because obviously the Battleshares is pitting these three assets against each other. So let's at least take a look at two of them. Let's first take a look at IBIT, your favorite. One of your favorite funds. Okay, so in the last 3 months, pulled in about 4 billion. And we've talked about this, absolute amounts of money that IBIT has on. It's been a hoover or vacuum. That's a British word for it. It has been a vacuum. It has been absolutely sucking up money. Year to date, 7.5 billion. But yeah, over the last week, 5 days, 1 billion in inflows. Because Bitcoin, again, is about 3%, I think, off from its highs. It's up over $100,000 again for one Bitcoin. I mean, performance 1 month, 21.5% over the past month. Volatility. So again, over at least the past month, it seems as if IBIT has been performing a bit like a store of value play amid all the volatility that we have seen in the market. Do you think this continues? Are you seeing, at least in terms of, not necessarily performance in terms of Bitcoin and IBIT, but do you still see investor appetite keeping this kind of pace?
I do. And I know we talk a lot about IBIT on this podcast, but it's just hard not to comment on an ETF that has put up the types of numbers. So before I answer your question, I've got to give you, I'm sorry, I have a few more stats for you. So
yeah, I love to hear them.
I love this stuff and I track it every day. So IBIT has now taken in new money for 20 straight days.
Mm-hmm.
Okay, working on that streak. It's also at an all-time high in terms of assets under management, so nearly 65 billion. And what's interesting about that, if you look at all the ETFs, there's 4,200 ETFs out there, that 65 billion places it in the top 30 of all ETFs by assets. It's done that in 16 months. The other stat that I'll add is that IBIT is now number 7. Actually, no, it's number 6 now out of those 4,200 ETFs in terms of inflows this year with over 7 billion. So point is, This
Wait, and I
ETF
have to use this moment to again do a little bit of a callback. If you haven't yet gone and seen, this is Pulse episode 13. I believe you need to go check out either Pulse episode 11 or 12 because we do talk about IBIT versus VU. If IBIT can surpass currently the world's largest ETF. Now, according to Michael Saylor, it can. So, and it sounds like you're, I mean, not that you're necessarily supporting it, but again, we had mentioned a couple of things needing to happen in order for IBIT to do that. But the fact that we've now seen IBIT in just 1 year, again, this fund has only existed it's been around for less than a year and a half. But for it to leapfrog from zero to the position that it is in now is absolutely incredible.
Well, and so then let me answer your question that you posed originally before I started spewing a bunch of stats and data and putting everybody to sleep. I think if you look here recently, my take on this is that this is real money being deployed. And what I mean by real money, I'm talking institutional investors and financial advisors, right? I don't think this is retail money. I think what's happened is the performance of Bitcoin over the past month or so, I think has really gotten the attention of big investors. And plus, even if we don't just look here recently, and we can talk about the performance of Bitcoin. You mentioned it being up over 100,000. Think about since these ETFs have launched. If you run performance of, say, IBIT going back to January of 2024, it's up something like 120% last I checked. And that's going to be the case for all of these spot Bitcoin ETFs. That is going to get the attention of big money, right? Like you can't be, not that you can't, but it's tough sitting something like that out, especially an asset class that has that much attention.
Yeah. Right. I mean, 1 year performance data right now is over 67%.
Right. But if you run it back to inception, I think you're talking like 120%. And again, that's a cherry picked. It's a random date when those launch. But point is, even if you go back a year, that's performance that's going to show up on the radar of real money.
Yeah.
And if you're an advisor, you're going to be getting questions around it. And so I just feel like there's a lot of momentum behind these products, and I don't see it changing. Now, is it going to catch VU? I'm not going to say that. But
we've discussed that already.
Yeah. But it's going to continue. I think these are going to continue taking in money, in real money. I honestly do.
Yeah. And also the access to it has continued to be eased as more and more brokerages just kind of buckle, I think, and cave to not just pressure, but I also just think where we are, right? Like you got to stay in the present and look to the future. You're going to have to start offering crypto. And I think your point is right. I think we heard when Bitcoin first came out, and I think when some of these funds, we knew that the funds that once these ETFs launched, that it was going to kind of democratize access to Bitcoin, because then you didn't have to deal with the wallet and transferring your money and then purchasing it and remembering this, code that you might lose, and you'd lose your money because you can't access your wallet. I think the funds made it so much easier for people to purchase Bitcoin that maybe wanted to before, but just didn't want to go through the whole process of it. But now I think what we still always heard was that a lot of people didn't understand Bitcoin. They didn't understand blockchain. They didn't understand the tech that it was kind of built upon. And they just thought it was BS. I mean, Warren Buffett regularly talks about how Bitcoin is BS. But again, I think that you can't ignore the fact that you would be missing out on massive gains.
Either way, I'm all over the place on you today. I think I'm all hyped up with my big victory lap, so that got me going. Who also is not ignoring Bitcoin and crypto?
Who?
The S&P 500, because they will be adding Coinbase to their holdings.
Yes.
And here's why I bring that up, because you were talking about access. Think about all of these VU investors, the Vanguard S&P 500 investors, who will now own Coinbase in their portfolio. But yet Vanguard is not offering brokerage access to their clients for spot Bitcoin and spot Ether ETFs. I love the irony of that.
We did come up with a mild prediction when Vanguard would actually open their doors to crypto. I mean,
I still believe it's going to happen. It's coming. I just don't. It's untenable. I don't know how they can continue to hold this.
I just wonder if it's a 2025 or a 2026 kind of flood that happens. We're going to see. Well, let's talk lastly about gold. All right. So we talked about IBIT. Let's talk about gold. It's another one of the assets that was a part of the Battleshares sort of cage match. So Van Eck came out $5,000 an ounce. We currently are sitting around 3,300, just pulled back slightly from the 3,500 that we had seen, which was the record high in gold. I mean, GLD, I pulled up some stats, has pulled in $7.2 billion in the last 3 months. Now, here's the case that Van Eck is making for 5,000 an ounce. Elevated but tolerable levels of inflation, geopolitics potentially being pushed, the U.S. economy being pushed to recession, and that while gold didn't perform very well at the beginning of the inflation cycle, that it will and has continued to do better further and further into the inflation cycle, which we do currently have. And as IBIT continues to perform very well, and the use case or the base case around the investors piling into IBIT, the same also exists for GLD. I mean, looking at the performance right now for gold, I mean, year to date, over 23%. I mean, it is so much battling IBIT in terms of performance. Again, not something that you can kind of ignore. And I think it's something that I don't think older investors are underinvested in, but I think younger investors are probably underweight to GLD. I just thought that was very fascinating that they were coming out, and their timeline, just in case anyone's wondering, I watched the interview, so I guess you don't have to. Although if you want to watch the interview, we did do a Talk ETFs episode last week, right, with Van Eck about this very issue. So feel free to go check it out at ETF.com. They're looking at 2026, 2025, 4,000 an ounce, 2026, $5,000 an ounce. So there's a lot of room to run in case you want to pile into it. I'm just going to leave you with that. I know that you're like, I've talked crypto. I don't necessarily have to talk gold, but
no, I mean, I'll just say, so obviously, again, I can't make price predictions on particular assets, so I'm not going to comment on the 5,000 prediction or whatever. But what I will say, like you ran through those 3 or 4 items as to why they believe gold can hit that mark. And what I've always said about gold, what's interesting is almost regardless of the type of market environment or what's going on in the economy, you can come up with a reasonable case for why gold will perform well. And that to me is...
I remember a couple episodes ago, you went back and looked at gold since its inception and compared it to the broader market. And
well, even if you look over the past 3 years, GLD has outperformed SPY by 20% over the trailing 3 years, which I think that would surprise a lot of people. But my point, Kristin, is just that gold, I always say this, I'm a broken record, it marches to the beat of its own drummer. And so those, in my opinion, those are the types of assets which can be valuable in a portfolio as a diversifier if you have a small allocation, because it's uncorrelated or has a low correlation, and that can provide some benefits in a diversified portfolio. So anybody who has had that smaller allocation of gold, it's been a huge benefit. Now, I don't think you want to go overload your portfolio with an asset like gold. I think you want to have a reasonable allocation, make sure you're rebalancing all the boring things that you always hear. But gold makes sense to me as part of a diversified portfolio because of those benefits. So, now do we want to talk gold versus Bitcoin? Do you allocate to both? I mean, that's a whole nother conversation. I do think, I've talked about this before, I actually think obviously older investors are much more comfortable allocating to gold, whereas younger investors are much more comfortable allocating to Bitcoin. And we have to see all this.
My take is both.
Yeah, and I think that's a reasonable position to have if you want to have both, because we've talked about, we still think Bitcoin needs to prove itself longer term as a store of value. We talked about that earlier. So it's interesting. I think gold is an interesting asset class, but both gold and Bitcoin, investors have love-hate relationships with these, right? I mean, if you get 10 investors or advisors in a room, you'll have half that go, yeah, I love gold, or I love Bitcoin. You get half that absolutely hate it. Say it's the dumbest thing. Why would I own a yellow rock or, ones and zeros, in the cloud or whatever? I mean, it's just, they're both very polarizing.
Well, we will leave it there with Nate Stradamus's last word. We will see what predictions he has on next week's ETF Pulse episode. But thanks so much for listening. And thanks, Nate, for joining.